Have you ever wondered that some people spend their whole lives working hard, saving carefully, and still end up struggling when they retire? The harsh truth is that many Americans over 60 are unknowingly hurting their financial future by holding on to assets that seem safe but actually keep them stuck. Warren Buffett has been warning about these traps for decades. His advice is simple and clear: own businesses or investments that produce real cash flow, keep your costs as low as possible, and stay away from the complicated financial products that Wall Street loves to push. In this video, I'll walk you through 10 specific assets that Buffett believes are quietly draining retirement wealth. Some of these might surprise you because they're often promoted as safe or conservative choices, but when you look at the numbers, the story changes. If you're over 60 and holding any of these, understanding this could be one of the most important financial steps you take this year. The first wealth destroyer is gold and other non-productive assets. Gold is often treated like a sacred investment, but Warren Buffett has been very clear about its weakness. In his 2011 letter to shareholders, he joked, "You can fondle the cube, but it will not respond." To explain further, he compared two piles. Pile A is the world's entire gold supply, about 170,000 metric tons, which would form a cube worth around $9.6 trillion. Pile B would cost the same but could buy all U.S. farmland, 16 Exxon Mobils, and still leave $1 trillion in cash. 100 years from now, the farmland will have produced massive amounts of food and will keep producing. Exxon will have paid trillions in dividends and built even more assets. The gold cube, however, will still be sitting there, unchanged, producing nothing. That's the key lesson: if an asset doesn't generate cash flow, it doesn't truly support your retirement, it just leaves you hoping it holds value. History proves this. Over the past 50 years, U.S. businesses in the S&P 500 have far outperformed gold because they earn, reinvest, and compound wealth, while gold just looks nice in a vault. I once met a retired engineer from Detroit who had 40% of his savings in gold coins. He thought he was being cautious, but when we compared his returns to a simple S&P 500 index fund, he realized he'd lost out on nearly $300,000 in growth over 20 years. The tax rules also punish gold holders. Physical gold and most gold funds are taxed as collectibles, meaning gains can be hit with rates up to 28%, much higher than the usual long-term capital gains tax of 15% to 20%. If inflation is your worry, there are better tools, like Treasury inflation-protected securities or I-bonds, which hedge inflation while still letting you earn. My rule for gold is simple: keep a tiny amount if it helps you sleep at night, but don't let a shiny, non-earning metal take money away from assets that actually create income and growth. If this opened your eyes, type "gold trap" in the comments to share what you've learned about why gold isn't the safe haven it's often made out to be. The second wealth destroyer is high-fee mutual funds, and this one quietly eats away at your money every single day. Many people don't realize how damaging fees can be until they see the math. The SEC shows that on a $100,000 investment over 20 years, paying 1% in annual fees instead of just 0.25% can cost you nearly $30,000, that's basically a full year of retirement expenses gone. Morningstar studied thousands of funds and found that the most reliable predictor of future success is simply the cost. Lower cost funds win more often than not. But the real trick is that fees aren't just about active versus index funds. They often hide in complicated share classes that most investors don't fully understand. These include front-end loads, level loads, and sneaky 12b-1 fees that quietly funnel money to brokers and fund companies out of your own returns. A good example is my colleague Mike from Ohio, who thought he was invested in a safe retirement fund. In reality, it was charging him 1.3% in hidden fees, which meant he was handing over $1,300 every single year on his $100,000 balance. Once we switched him to a low-cost S&P 500 index fund, it was like giving himself a $125 monthly raise for the rest of his life without doing any extra work. Warren Buffett's advice is very straightforward. For most people, the best plan is to put 90% of their money into a very low-cost S&P 500 index fund and the other 10% into short-term treasuries. If you're not sure what you're paying right now, use the free FINRA Fund Analyzer tool to compare your funds with lower-cost alternatives. The difference you'll see over 20 years could completely change your retirement, and it might shock you just how much money you're giving away in fees without realizing it. The third wealth destroyer is long-duration bonds, which many people mistakenly believe are the safest part of their portfolio, but in reality, they can be one of the riskiest, especially for retirees. The key concept here is duration, which measures how sensitive a bond is to interest rate changes. For example, if your bond fund has a duration of 10, a 1% increase in interest rates could cause about a 10% drop in its price. That means instead of safety, you're actually facing stock-like volatility but without the long-term growth that stocks provide. Warren Buffett has warned for years that, over the long run, a diversified stock portfolio can actually be safer than bonds because it grows while bonds just sit there and lose value when rates rise. Many retirees found this out the hard way in 2022 when some long-term bond funds dropped more than 20%, a shocking outcome for money they thought was secure. The better approach is to match your bonds to your spending needs rather than just chasing yield or holding long bonds. If you'll need the money in the next 5 years, one smart strategy is to build a treasury ladder by buying 1-, 2-, 3-, 4-, and 5-year treasury notes so that something matures each year to cover your expenses. This way, you don't have to sell bonds at a loss if rates rise, and you keep stability in your portfolio. The bottom line is that long bonds aren't real safety for retirees who depend on steady income, and recognizing this can save you from unnecessary losses. Have you ever been caught in one of these wealth traps? Share your story in the comments because your experience could help someone else avoid the same mistake. The fourth wealth destroyer is timeshares and vacation clubs, and while they sound appealing because of the memories and vacations they promise, the real problem is the math that quietly works against you. These deals come with annual maintenance fees that almost always rise, unexpected special assessments that hit without warning, and a resale market so overcrowded that the FTC calls it extremely difficult to escape. In 2024, the average annual maintenance fee reached around $1,222 to $1,260 per interval, up about 8% from just the year before, and the bills keep coming whether you use the property or not. The worst part is what happens when people try to sell. Scammers often appear with big promises and demand upfront fees, and many desperate owners fall for it. I know a couple from Texas who bought a Florida timeshare 15 years ago and, between fees, assessments, and in used weeks, ended up paying more than $35,000 beyond the original cost, only to later find out their unit was worth far less on the resale market. The smarter alternative is simple: if you love a resort, rent when you want to go. That way, you pay as you go, keep your flexibility, and avoid endless bills. If you're already stuck in a timeshare, start by contacting the developer or owners association about deed-back or surrender programs, which do exist even though they're rarely advertised. Always work only with licensed brokers who specialize in timeshares, and never hand over money upfront to anyone promising a guaranteed sale. Instead of pouring money into fees, redirect it into a dedicated travel fund that earns current treasury bill rates, which are now over 4%. This way, your vacation money actually works for you when you're not using it, giving you both freedom and better financial returns. The fifth wealth destroyer is single stock concentration, and it's a trap that many retirees fall into without realizing the danger. Having too much of your retirement tied to one stock, especially your employer's company, can feel safe because you know the business, you've worked there, and you've watched the stock for years, but the numbers tell a different story. Academic research shows that over long periods, about 55% of individual stocks actually underperform treasury bills, which are considered one of the safest investments available, and even more shocking, only about 2% to 4% of all stocks are responsible for nearly all of the stock market's long-term wealth creation. That means if your retirement depends on one ticker symbol, you're really gambling that you've picked a rare winner, and that's not a reliable plan for the future. The risk is even worse with employer stock because if the company runs into trouble, your paycheck and your retirement portfolio can both take a hit at the same time. Just ask former employees of Enron or Lehman Brothers how devastating that can be. Warren Buffett has always recommended the opposite approach. Instead of betting everything on one company, spread your risk by owning the entire market through low-cost index funds, where the winners and losers balance out and you capture the overall growth of American business. A smart way to protect yourself is to set a maximum limit for any single stock, often 5% to 10% of your portfolio, and if you're over that, make a written plan to slowly reduce your exposure, maybe by selling 10% of your shares every quarter until you're back within the safe range. Then, use the money to buy broad market funds, which allow hundreds of companies to work for your retirement instead of putting all your trust in one. This way, you trade speculation for security and give yourself a much stronger foundation for lasting wealth. The sixth wealth destroyer is high-fee variable annuities, and while they're often sold as a way to give retirees peace of mind, in reality, many people end up paying far too much for that so-called security. Variable annuities are loaded with stacked fees, starting with mortality and expense charges of about 1.25% per year, then adding administrative costs, fund management fees, and extra charges for riders and guarantees. When you add it all up, it's common to pay 2% to 3% or even more every single year, and on top of that, most contracts come with surrender charges that can lock you in for 6 to 10 years, which means you're stuck while these fees quietly eat away at your money. What makes this worse is when retirees buy a variable annuity inside an IRA. The SEC makes it clear there is no extra tax benefit in this setup, so you've only added unnecessary costs and complexity without getting anything in return, and when you finally withdraw, the earnings are taxed as ordinary income, not the lower capital gains rate you'd pay on stock investments. If what you really want is guaranteed lifetime income, a plain immediate annuity is usually much cheaper and easier to understand, and if you already own a variable annuity, it's worth requesting a detailed breakdown of all the fees, checking your surrender charge end date, and knowing your annual free withdrawal allowance, which is often 10%. If the costs are draining your retirement and you don't need the extra insurance features, you can consider a 1035 exchange to a lower-cost contract, though you'll have to be cautious because it restarts the surrender period. Warren Buffett's philosophy applies perfectly here: keep your investments simple, avoid high costs, and focus on owning productive assets that generate real returns instead of contracts that slowly consume your wealth with endless layers of fees. The seventh wealth destroyer is idle cash that earns almost nothing, and while keeping money in cash feels safe, too much of it sitting in low-yield accounts is like paying an invisible inflation tax every single day. Right now, the national average savings account pays about 0.6%, while short-term treasury bills have been paying over 4%, and that gap is real money retirees lose without realizing it. Of course, you still need some cash, an emergency fund for 6 to 12 months of expenses and money set aside for near-term spending, but there's a big difference between smart, strategic cash and lazy cash just sitting around. Even Warren Buffett doesn't let Berkshire Hathaway's billions sit idle in bank accounts. He places it in treasury bills where it actually earns something with minimal risk. A smart system for retirees is to keep your emergency fund in a high-yield FDIC-insured savings account for quick access, then for money you won't need for 3 to 12 months, build a treasury bill ladder, buying bills that mature when you need the money. This strategy ensures you always have liquidity when needed while earning a much better return than a typical bank account. Another advantage is that interest from treasury bills is exempt from state and local taxes, which is a big deal if you live in high-tax states like California or New York. You can buy treasury bills directly on the Treasury Direct website or through most brokerages, and current rates are published daily. By simply shifting lazy cash into higher-yielding, safe options, you could add hundreds or even thousands of dollars a year to your retirement income without taking on any stock market risk, which makes this one of the easiest and most effective wealth-protecting moves you can make. The eighth wealth destroyer is cash value life insurance, which often sounds like a smart way to combine protection and investing, but for many people over 60, it ends up being an expensive and inefficient way to store money they actually need for retirement. Policies like whole life, universal life, and variable universal life pile on costs, sales charges, surrender fees, mortality and expense charges, administrative fees, and in the case of variable policies, the underlying fund expenses too. All of these eat away at your cash value and can even force you to pay higher premiums just to keep the policy from lapsing. There's also a hidden tax trap many retirees don't see coming. Policy loans aren't taxable while the policy is active, but if it lapses with an outstanding loan, that borrowed amount can suddenly count as taxable income, leaving people with surprise tax bills of $20,000 or more. Warren Buffett has always emphasized keeping things simple and low cost, and this is where his advice applies perfectly. If you truly need life insurance for protection, buy a plain term policy and invest the difference in low-cost index funds. It's almost always cheaper, easier, and more flexible. If you already own a cash value policy, don't just ignore it. Ask your insurance company for an in-force illustration so you can see how the policy performs under different scenarios. Review your surrender charge schedule, check for outstanding loan balances, and understand your lapse risk before it becomes a costly problem. If you no longer need the insurance protection but have built up cash value, look into whether it makes sense to surrender the policy or transfer it into a simpler, cheaper contract through a 1035 exchange. The key question you should ask yourself is this: am I buying life insurance for actual protection, or am I treating it like an investment? For most retirees, the reality is that there are far better and more reliable ways to grow wealth, and sticking with simple investments can save you from the hidden costs and risks of cash value policies. The ninth wealth destroyer is negative cash flow rental properties. Real estate can be a powerful way to build wealth when it actually pays you, but many investors over 60 are unknowingly losing money every month on rental properties that don't generate positive cash flow. The tax rules make this even trickier. Rental losses are generally considered passive losses, which means they usually can't offset your salary, pension, or Social Security. Those losses get carried forward on your tax return until you have passive income or sell the property. There's a small $25,000 allowance if you actively manage the property, but it gradually disappears as your income rises, and many retirees never fully benefit from it. Meanwhile, the reality of property ownership hits hard. Roofs leak, air conditioners fail, tenants leave, insurance costs rise, and repairs pile up. If your rental doesn't produce positive cash flow after accounting for realistic reserves for maintenance and vacancies, you're running a business that drains your money and energy instead of adding income. To avoid this trap, run a thorough, honest cash flow analysis that includes a 5% to 10% reserve for major repairs, realistic vacancy periods, management costs. Even if you self-manage, your time has value, and all expenses deductible on Schedule E. If the property can't generate positive cash flow within 12 to 18 months, it may be time to sell and put that money into liquid, income-producing assets. You could also consider a 1031 exchange into a property that actually produces cash flow, or sell outright and use the suspended losses to offset capital gains elsewhere. Following Warren Buffett's advice, focus on owning businesses or assets that generate real cash rather than projects that constantly consume it. The 10th wealth destroyer is the oversized house, another common trap that can silently drain your retirement funds and limit your financial freedom. This last wealth destroyer is sensitive because it involves your home, your comfort, your memories, and your sense of security, but if your house is bigger than what you actually need, it can quietly drain your retirement funds. Larger homes come with higher property taxes, insurance, utilities, and maintenance costs, none of which generate income. They simply consume money you could use elsewhere. For example, the national average homeowner's insurance premium hit about $2,370 per year in 2024, and costs are rising faster than inflation in many areas. When you sell your primary residence, you can exclude up to $250,000 of gains if single, or $500,000 if married, provided you've lived there for 2 of the last 5 years, which gives you real money to redeploy into income-generating assets. Take the time to calculate your home's total carrying costs over the last year, taxes, insurance, utilities, repairs, and improvements, and compare that to what you actually need. If your home's expenses force you to withdraw more from retirement accounts, downsizing may be the smarter move. You can use the freed-up equity to build a treasury bill ladder for near-term expenses and invest the remainder in low-cost index funds so your capital works for you instead of your roof. The goal isn't to remove all emotion from the decision, but to understand the real financial cost of your choices. All 10 of these wealth destroyers, gold, high-fee mutual funds, long-duration bonds, timeshares, single-stock concentration, high-fee variable annuities, idle cash, cash value life insurance, negative cash flow rentals, and oversized houses, either fail to generate sufficient income or actively drain resources from your retirement. Warren Buffett's approach is simple and effective: own productive businesses through low-cost index funds, keep safe short-term funds in treasury bills for immediate needs, avoid complex, high-fee products, and let compound growth do the heavy lifting. You don't need to panic or sell everything at once, but you do need to be honest about what's helping you grow wealth and what's holding you back. Tonight, pull out your most recent account statements and identify how many of these 10 wealth destroyers you currently own. Make a written plan to address them one at a time, starting with the easiest fixes, such as moving idle cash into treasury bills or switching a high-fee mutual fund to a low-cost index fund. Build momentum with small wins, and your future self will thank you for every unnecessary fee eliminated and every dollar redirected into productive assets. This is only the beginning. There are many more strategies that can help Americans over 60 secure real wealth and long-term financial stability. Finally, rate this content from 1 to 10 in the comments and tell me which of these wealth destroyers surprised you the most. I read every comment and use your feedback to create even better content. If you found this video useful, be sure to like, subscribe, and turn on notifications to not miss our future uploads. See you in the next video.